welcome to The Firm. On the show this week, the Competition Commission of India orders its first structural remedy ever. And CCI Chairman Ashok Chawla, in an exclusive interview, cautions the private equity industry, hints at solving the Thomas Cook problem, and explains the Tesco surprise. It's the first time that India's competition regulator has ordered the sale of certain assets before approving a merger. CCI gave the $4 billion Sun-Ranbaxy deal conditional approval. The two companies must sell 7 select products identified by CCI before the merger can take place. Now, this CCI order will set precedent for other such deals in India. And hence today we're going to examine what it says and what it means. And to do that, I have with me Amitabh Kumar of JSA and Samir Gandhi of AZB. Gentlemen, thank you very much for joining us on the phone. Let me start first by asking you about what you make of the timeline within which this Phase 2 application has been dealt with by the CCI, given that this is the first such big mega pharmaceutical merger that CCI has dealt with. The deal was announced in April and we have a decision come in from CCI in December. Samir, how do you assess CCI's ability to sort of come to grips with this quickly enough?
Well, Menika, I think the CCI has done a pretty good job. This is the first time that they've had to undertake an exercise such as this. So to that extent, they, I think, were mindful of the 210 statutory day period within which they needed to clear this. Okay,
Mr. Kumar, here's what I pick up from those involved in the deal. They were a little dissatisfied, let me put it that way, with the lack of sufficient pre-merger consults and post-merger consults with CCI. And in fact, they had a parallel process running with the FTC. In that process, I'm told already that they have understood what the pain points of the FTC are and are already working on divesting some products so that the FTC can give them the go-ahead in its order, as opposed to the fact that with the CCI they've run through a 210-day period. Now there is an order and then they will have to go through the divestitures before they can get final approval for their merger. In mergers, time is money. How do you assess how CCI has dealt with this?
I mean, see, there is a little design fault here.
Okay.
Because if you look at the jurisdictions in the US or in the EU, there is the parties who, when they find these pain points, they go and suggest modifications to their own proposal. But if you look at our law, it says that the CCI will provide the modifications.
Yes.
Which, if the parties do not agree, they can give their amendments. Now, CCI being a competition agency will not perhaps know the market or industry as well as the parties to the transaction. So it is put in the reverse that it is the parties who should give the modifications once they have entered into negotiations with CCI on finding what CCI feels are their concerns. And probably this delays the whole process. So probably if this is taken care of in the next round of amendments, perhaps things will be faster.
All right, that's a fair enough point. Let me now come to how CCI has determined relevant product market, therefore how it's determined which products will have an appreciable adverse impact on competition, and therefore how it's determined which ones need to be sold. Samir, they've used the molecular level to determine relevant product market. Is that in keeping with precedent for pharmaceutical deals across the world?
Well, I mean, Menika, they have indeed defined it at the molecular level, and we have, at least in the past, seen some previous decisions of the CCI to define the market at the shall I say, the therapeutic level. So to that extent, it is a bit of a departure of what they've been doing in previous deals here in India as well. And we were a little surprised at this, but let me put it this way, which is that we've always known that there has been a possibility of defining the market at either of these two levels. It's not entirely out of sync with what happens elsewhere in the world as well.
Okay, I sense a big but coming in there in your answer. So let me try and provoke that one. They haven't just looked at the market share of the combined entity post-merger to determine how or what the adverse impact could be, right? They've obviously taken also the market share or, the leadership of the remaining competition, the strength of the remaining competition. So there have been instances where the combined market share of the entities would be more than 60% 60%, but they haven't said that product needs to be sold. And yet, in one case where the combined market share of the two was about, I think, 40% or so, they've said the product needs to be sold because the competition remaining in the marketplace is not strong enough. When you see this data that they've put out, does it give you markers as to how CCI will deal with future deals?
I think the metrics that they have used, at least from what one reads of the order, seem to be simply, well, A, market share, B, what is the next significant competitor, how many other competitors exist in the market. But I think we're used to seeing worldwide other metrics such as market concentration reflected as an HHI ratio, the Hirschman-Herfindahl index, and also as a CR4 ratio. Again, one understands that it's possible that they use these ratios to understand market concentration, but there is nothing in the order which suggests that A, indeed, that they have used it, and B, more importantly, what the outcome of such analysis was. So when you speak of what kind of a message this decision leaves, what kind of a precedent it sets, I think we're still a little unclear after this decision as to what the CCI considers in the pharmaceutical industry as being a problematic market share and concentration ratio, which means that business is left a little bit in the dark. This goes back to the question about whether they could have offered those remedies earlier.
I'd like to add three things here. One is that, this is a phase 2 investigation where the parties have been asked to put in their objections, and CCI does note that they have got objections from many parties which have been examined. Now, we do not know what kind of objections were received and whether they went into its analysis of whether there is going to be a harm to competition in this market. So that part is missing. The second thing that I would like to add is that, okay, market shares are important, and if you are having 85-90%, perhaps, there is very little to argue. But, I'll take you back in time to the famous Boeing-McDonnell-Douglas merger, which also was creating the same problem, that out of only 3 parties available in the world, 2 were merging, and so they would leave 2. And that is when the thought came out that the market has to be contestable. So it's not necessary that if there are 3 big large players and they are getting reduced to 2, it necessarily affects market. Now, what has not come out in the analysis, which probably CCI may have done, as Samir puts it, but it is not there in the order, is the trend. Now, if the merging parties have even 70% market share, but the third competitor has 25, but it has gained 0 to 25 pretty quickly, then perhaps the market still remains contestable. So without all this analysis, I agree with Samir that it's a little gray area into how CCI will look into it in future.
All right, that brings me to the last point, Mr. Kumar, that I want to bring up, and the fact is that this deal for a final approval from the CCI requires an upfront buyer, which is that the 2 parties must sell these 7 products before their merger can be consummated. It's not unusual for authorities to ask for the divestitures to take place before the merger is approved. But it links into the very point that we've been talking about, saying if you don't do robust pre- and post-merger consults and you wait till the timeline is exhausted, you are going to end up, forcing the parties to spend more time doing what it takes for the deal to be consummated.
Yes, Menka, I agree with you because, it's like, if you take the 2 divestiture periods, in case the first does not succeed, then we are looking at 6 plus 4, 10 months. I'm reminded of the famous Staples Office Depot case in the US, where the court gave an injunctive relief to FTC after 8 months of hearing, and the parties withdrew their applications because they felt that 8 months have already gone. In another couple of months, the market situation will not remain the same at which they had negotiated their deal. So 10 months is a fairly long period, and that combined with the fact that this is the first time that there will be a monitoring agency which is going to monitor and then also perhaps sell the assets if this doesn't succeed, does throw some practical problems before the 2 merging parties.
Let me also raise one additional practical issue, which is that in the Sun-Ranbaxy case, it is indeed the case that it was a purely Indian deal, in the sense that parties' closure or the ability to close the deal is held up until they are able to divest the asset. But consider for a moment where there is a global transaction, a large multinational, multi-jurisdictional global transaction, where as a result of an order of the CCI, the global deal itself is unable to close. So it becomes quite problematic from that perspective as well, because one depends on the other. The global deal needs to close for the Indian companies to have a sense of whether this transaction is going to go ahead, but the global deal cannot close until an asset which belongs to one of these Indian companies is actually sold. So I think again, when I sit back and I look at Sun-Ranbaxy, I don't think it does enough to give us much in terms of precedent, either by way of process or for that matter by way of substance. I think it's a good decision, all things considered, but I do hope that the CCI considers what a number of people have been saying in the past, that there is a need for detailed guidelines, as is the case in many other developed jurisdictions, to give India Inc. that certainty about how their mergers are going to go ahead in complex situations like this.